Hi, everybody. Welcome to another episode of Capitalize on Retirement. We got a little change of scenery today. Is current podcast room is under construction as we're doing a little office expansion. So we're sitting in one of the conference rooms right now. So a little change of scenery,
Yeah,
but we'll see how it goes.
we're gonna be off our game today. So
Yeah, I don't know. But I think we'll be all right. We'll figure it out. But today we are going to talk about quarter one 2026 and what happened in the market and kind of start off with it was a little bit of a crazy quarter.
yeah, it was definitely crazy. I mean, anytime there's volatility in the markets, we get a lot of questions,
Yeah,
right? Is this
naturally.
and the one that we hear all the time, how did we go from record highs? Because it felt like in January and February, the market just kept going up.
Yep.
Right. And then finally it kind of hit that roadblock and it started to pull back a bit.
Yep.
And everybody always looks at it and says, this time is different. Right. And
Yep.
we hear that all the time. And so today we're here to talk about kind of what happened and, what we think is best moving forward.
Yeah, and I mean I think 2026 that was kind of a masterclass on how fast markets can change.
Yeah.
If we look at 2025 was just a bull market in general. We had basically we had a pretty strong dip there in April with
Yeah.
tariffs, but that was it.
Yep.
Outside of that, I mean, it was a really strong market, not a ton of volatility outside of,
Yeah.
a couple, maybe a month of volatility.
Yeah.
And now we're kind of seeing things shift. And it's not that the market was bad. I think, obviously news, we're selling things on the news, we're
Yeah.
selling media, and they feed off that. But the market wasn't too bad, and as we're sitting here today it's starting
Nah.
to clear up a bit. So let's kind of set the scene and start with what happened. So like January we started with a ton of momentum.
Yeah.
Right, we were breaking records all through last year, through January. Confidence was high, people were feeling great.
Yep.
And it felt like we were really entering a strong year. Usually when January is good, the market tends to fall off.
Yeah. Yeah. And I mean, everything looked great. I mean, there was nothing that was saying, "Hey, markets are going to pull back and 2026 isn't going to be a great year." Everything kind of looked really good. And
Yeah.
so, what happened was, and here's the kind of the best way to think about this. The market didn't crash, but it kind of lost visibility.
Mhm.
Right. So if we give an analogy here, it's kind of like when you're driving down the road on the highway and all of a sudden you kind of see the fog and you don't necessarily slam on the brakes, but you kind of pump the brakes and you slow down a little bit. And I think that's what happened with the market because there was some uncertainty. And there were a lot of reasons why. I mean, the government was shut down. Nobody knew what the Fed was going to do with interest rates.
Yep.
So I think that's what really had the markets kind of pull back or at least pump the brakes a little bit.
Yeah, and I'm looking at the data here, and we had the government shutdown, so obviously we were missing data there, and that
Right.
was basically 43 days. Investors were basically guessing.
Right. They didn't know what the jobs data was. They didn't know
No.
what anything was.
No, so I mean, a lot of Fed uncertainty. There's unclear direction there, right? We were supposed to get interest rate cuts.
Yeah.
Personally, I don't think that's going to happen. I don't
Yeah.
know what the optimism is on that right now, but with everything going on, that's going to be tough to do. And then political tension. I mean, there's rising stress right now politically.
Yeah. Yeah. And I mean, that's 43 days. I mean, it doesn't sound like a long time, but for investors, it makes things a little bit uneasy when you don't know what to expect.
And we're in a data-driven market, right?
Yeah.
The market is driven based on the data and the numbers that we have.
Yeah.
So when you don't have numbers, you don't have clear decision-making ability.
Yeah.
And I mean, I think one of the things, and I know we're going to go through the numbers and go through a lot of what has happened and all of that, but I think one of the main things is that's, we talk about it often about having a plan in place. And I think having a plan, like we sat down for a lot of reviews last year and talked about taking some chips off the table
Yeah.
and things like that. I think that's why you have to have a game plan in place,
Right.
and you can't just be kind of flying by the seat of your pants, especially in retirement.
Right. So let's jump into the numbers. I mean, the market kind of pulled back. So how much did it pull back? Well, the NASDAQ was down over 7%.
Yep.
The S&P was down around 4 to 5%, and then the Dow was down around 3.5%. So it wasn't a disaster, but after a few years of the market going up, it kind of felt like, oh man, this is the time where it's really going to pull back. So it was enough to kind of shake confidence, I guess.
Yeah, it definitely shook confidence. And I think again, like the news is selling it a little harder than it is. Like the
Yeah.
market was down, but it wasn't down all that much. I mean, 4 or 5% isn't crazy. I mean,
No,
that's natural market
that's
movements,
what
you
they
know.
do. Yeah, it's natural pullbacks.
Yeah. And it kind of had to happen. I mean, we did a podcast earlier in the year how we were on 3 years of over 15%. Like
Yeah,
that's not too common.
right.
But it does get interesting. I think, we talked about this earlier. The part that people missed is it wasn't a broad market collapse,
Right.
right? It was kind of a shift. So some parts of the market struggled, but others really did quite well.
Yeah, and I mean, if you think about it, so a lot of people talk about what has really done well over the past 5, 10 years. It's really been tech.
Yep.
So instead of tech really continuing on its path upward, tech pulled back, and things like energy and consumer staples, those are the things that really did well. I think
Yep.
energy was up over 30%
Yep. Yep.
through that time period. So,
Yep. Tech and AI pulled back. The Mag 7 specifically. The
yeah,
Mag 7, has led the way. Before that, it was FANG. And those stocks have absolutely just crushed it over the past
yeah,
couple of years. And they pulled back. So everybody kind of quantifies that to the overall
right,
stock market.
exactly.
But like you said, energy surged. Energy was up over 30%. Utilities and staples held strong.
Yeah,
Foreign stocks were good.
yeah, yeah. So it's not a bad market. It's just there's different markets and they do different things.
I think that's why, we talk about it in our strategy sessions with the families that we serve. Like diversification is key, especially right now.
Oh yeah,
I think having a portfolio that is truly diversified across obviously US stocks, small, large, medium, small, across the different sectors,
yeah.
having international exposure, having bond exposure, having some diversifier in there. I think you have to have diversification in a time like this because it's critical.
No, I agree. I mean, let's talk about kind of the turning point. Because obviously money started kind of changing hands, let's say. Instead of everybody going to tech, things started to shift to energy. And there was kind of a turning point in there where the moment really shifted. And in late February, obviously a lot of our viewers know this, but the Iran war, right?
Hmm.
A lot of things were uncertain at that time. And so oil prices didn't just rise, they went from about $60 a barrel to $100 a barrel um, in a really fast time frame.
Yeah, that's a massive increase, and we're seeing it at the gas pumps now.
Yeah.
So gas prices have followed that, and markets reacted fast.
Yeah.
And that's kind of what happens. The market's going to react to things like that as it should. But again, it's not as bad as everybody thought it would
Nah.
be, right? That's kind of the way it goes. And I think the main thing is, companies kept spending,
Yeah.
companies kept earning, the economy kept moving, even while all this went on. So growth slowed a little bit,
Right.
but the economy didn't break and markets didn't spiral.
No, that's the biggest thing. Like throughout all of this, companies would come out with earnings and say, our earnings look great.
Yeah.
Everything's good. We're making money. We're more profitable than we were the year before. And so looking at that when our clients would call in, say, hey, there's not that you don't have anything to be worried about, because we always do, but it just didn't feel like it was absolutely going to collapse.
No, no. I mean, I think that was just the news kind of
Yeah.
spinning headlines, and that's kind of what it is. But I think the main thing, as we kind of get to that, the market wasn't all that bad. It really wasn't. It was negative, but we're here middle of April now, and the market's kind of cleared up over the last
Yeah.
couple weeks. We'll see if that continues. But what matters now, and most importantly, and we focus on this all the time, how do we move forward, and what do we got to look for moving forward?
Yeah.
There's three main things. Do you want to hit those? And
Yeah. We'll talk about the three things. So the first one is the Fed. Well, rates come down later this year. I don't think anybody really knows what's going to happen at
Mhm.
this point, but I do know that if you look at the 10-year treasuries, which is what everybody looks at for the interest rates, it has peaked up. So it started to go up. It was at right around 4 for a while. Now it's up to like 4.3. I think it was almost at 4.4 for a while. So they started to tick up, and a lot of people want interest rates to come down. It's
Yep.
typically good for the market. So I think people started to shift from stocks to bonds, and it really raised interest rates.
Yep.
And
And I
and it
mean,
makes sense.
with inflation and things like
Yeah,
that, with higher gas prices, right? That's causing
right.
inflation. So it makes it tough for the Fed to cut rates and
Yeah,
situations like that. So that's a big variable. Will rates come down later this year and
yeah.
a
Uh,
big unknown.
right, a big unknown for sure. Another one being politics. Obviously, it's a midterm year, and there's always noise in the markets when that happens. Unfortunately, I mean, it's all based on company earnings. You're investing in companies, and it should be based on the earnings. But yeah, mid-year elections, they typically
Yep.
cause volatility in the markets.
Well, I think the market now more than ever, it moves on noise and it moves on news and people
Yeah,
react to the news, not so much the actual fundamentals of the market or the economy.
yeah,
So it's going to be a political year, it's a midterm year, and there's going to be a ton of noise, which increases volatility. Volatility doesn't mean bad markets though.
yeah.
It just means up and down. It's probably more normal than what we've seen in the past.
Oh yeah, for sure. I mean, and the third one just being earnings, right? So we have the Fed, politics, and earnings. And if companies are still delivering results, markets tend to follow, even
Yeah.
though there's going to be short term volatility. And so everything has looked good with the companies that have reported earnings. For a lot of the companies, some are not as great as others, but
Yeah.
so
I think the biggest thing there is just don't be an emotional investor, right? Stay the course, kind of zoom out. Don't
yeah,
let the short term noise impact your long term decisions because that impacts long term results. So I think that's probably the best advice
yeah,
that we can give there.
yeah,
That short term noise, I mean, it bothers us and emotionally impacts us, but
right.
long term over your investments, it's really not going to harm you. And I know with our pre retirees and retirees, we've set a plan in place that
Yeah.
we know we can sustain that volatility.
Yeah, and just so people know what they're actually invested in, like oil went from 60 to $100 a barrel basically overnight.
Yeah.
And so, yes, if we had all of our money in energy, that would have been great.
Yeah.
But just so our clients know, they have some money in energy, they
Yep.
have some money in tech. Like
Yep.
it's very diversified. So, a portion of their portfolio was actually doing really well, while
Yep.
the other portion was kind of pulling back a little bit. It's all healthy. It all happens in the market, and that's why it's important to just be diversified and have all kinds of sectors of the economy in your portfolio.
Couldn't agree more. Even this year, I mean, international stocks are up.
Yeah. I think
International's up.
I actually think as of today the S&P actually went positive.
Two
Um
2%. I just looked at
yeah.
it on a
Yeah.
review this morning. It was up 2.05%. So,
Yeah.
these numbers are obviously March 31st.
Yeah.
We're today's April 15th, tax day. Um, so as of this recording, but we're up 2.04% as of this morning.
Yeah. So the real lesson here is, headlines feel urgent. They're rarely important. It's that headline. Like you said, they sell newspapers based on typically negative headlines,
Yeah.
right? They sell
Yeah.
more, um, and so markets react on noise in the short term, and we always know that. So just don't get spooked out of it. Stay the course.
That's what I was going to say. I mean, what should you do? Right. And I think you just said, and the answer is candidly not much.
Yeah,
Not
not
much.
much.
Stay the course, stay focused on the plan, don't follow the headlines. Make adjustments when needed, but that's obviously what we're here for, right? And we do that as we sit in our review meetings or our strategy sessions, do that at the end of the year because
Yeah.
it's important, but those who do will come out ahead in the long run.
Yeah, and if this quarter felt unpredictable, I think a lot of quarters moving forward are going to feel unpredictable because there's just so many different things that are at stake. And that's always going to be the case. I think there's always going to be, well, what if this happens? Or what if that happens? That's going to be forever. Right. And it's important to understand that that'll be forever and maybe just tune out CNBC every once in a while when things are going a little bit negative. So,
Yeah, I mean, I think I would say this is more normal than the last couple years
yeah.
have been, right? And if we feel that way and felt uncomfortable or anything, that's because it was, but that's also part of investing, and
Yeah.
the goal isn't to avoid it; it's to be prepared for it.
So we have to understand that to get all of the growth of the market over time, we have to go through that volatile time.
Yeah, absolutely. Um, that's kind of all I got on Q1. Well, I'm excited to do Q2 so we could kind of see where where we were on some of this. But is there anything you want to add, or you want to kind of close this down, or?
No, I think the goal isn't to avoid, volatility in the market. It's kind of to be prepared for it. And a lot of our clients do have a plan for these volatile times. So if you guys do like the podcast, if you guys could like and subscribe, that would be great. And then share it with a friend if you think it could be helpful to them as well.